Have you ever looked at the interest your savings account pays you and thought, this can't be all there is? You leave your money sitting there, month after month, and the return is barely enough to buy a cup of coffee. Meanwhile, other people are quietly collecting steady income every single month or quarter from investments most beginners don't even know exist. And today, you're about to discover 7 of those income-producing assets that could potentially pay you more than your savings account ever will.
Hi there. Before we dive in, please take a moment to read the full disclaimer on the screen.
Before we start, think about this for a moment. If your money is going to sit somewhere anyway, shouldn't it sit somewhere that actually pays you? Let me know in the comments what percentage your savings account currently earns. I'm genuinely curious to see how different it is for everyone watching this. Now, these 7 dividend ETFs aren't get-rich-quick schemes. They're not magic. But they are powerful tools used by smart investors who want steady, reliable income without having to pick individual stocks or constantly manage their portfolios. You don't need to be an expert, you don't need to be wealthy, and you definitely don't need a degree in finance to understand this. All you need is attention for the next few minutes, because each ETF on this list plays a different role. And by the end, you'll know exactly why so many people believe dividend ETFs are one of the simplest ways to grow wealth passively. And hey, if you like videos that help you make smarter money moves in a simple, no BS way, make sure to like this video, subscribe, and share it with someone who could use this information. It really helps the channel, and it motivates me to keep bringing you valuable content. All right, let's dive into the first of these 7 ETFs that could pay you more than your savings account. The first one is known for holding some of the biggest, most stable companies in the world. Companies that don't just pay dividends, but grow them year after year. Think of businesses that have survived recessions, market crashes, and every kind of challenge you can imagine. This ETF is built on companies that have raised their dividends for decades. What makes it exciting is that you're not betting on one company doing well. You're tapping into a whole group of time-tested businesses that have proven they can keep paying investors even when times get tough. Many investors choose this ETF because it offers something rare, stability with growth potential. Not only does it pay a solid dividend yield, but the underlying companies inside it tend to increase their payouts over time. That means today's small dividend could be tomorrow's much bigger one. If you like the idea of your income rising while you do absolutely nothing, this ETF deserves your attention. Now, while this first ETF focuses on long-term consistency, the next one on the list is more income-focused, meaning it pays you more cash up front. This specific ETF is what many people turn to when they want a higher dividend yield, especially compared to traditional savings accounts. It does this by investing in companies that may not grow as fast, but generate strong cash flow and share that cash with investors. This ETF can sometimes pay double or even triple the interest of a standard savings account, depending on market conditions. But here's the interesting part. Higher yield doesn't always mean higher risk. Because it's still diversified across many companies, it reduces the danger of relying on any single business. Here's something I want you to think about. Would you rather get smaller payments from super stable companies or larger payments from a wider mix of income-focused companies? Tell me in the comments. I really want to see where most people stand on this trade-off. Moving on, the third ETF takes a bit of a different approach. It focuses on companies with strong financial health. These are businesses with low debt, stable earnings, and solid balance sheets. Why does this matter? Because companies with good financial health are more likely to maintain their dividends even when the economy gets shaky. This ETF is popular among investors who want high reliability. It may not always have the highest yield, but what it lacks in yield, it makes up for in quality. Think of it like choosing between a car that goes super fast but breaks down often, versus a car that just keeps running forever with almost no issues. This ETF is that reliable car, and over time, reliability usually wins. Now here's where things get really interesting. The fourth ETF uses a strategy that boosts yield by combining dividends with an options-based income approach. You might not be familiar with options, and you don't need to be. The ETF does all the work behind the scenes. What you get is a much higher income stream, often far above what savings accounts offer. This ETF is attractive to people who want strong, consistent cash flow, but without the complexity of trading themselves. Here's a question for you. If there was a way for your investment to earn money, not just from dividends, but also from an income strategy running quietly in the background, would you prefer that over a traditional ETF? Drop your answer in the comments. I think the responses will be really interesting to read. Now, before we go deeper, if you're enjoying this breakdown and you haven't already, remember to like, subscribe, and share this video with someone who wants financial freedom. Let's keep this momentum going. The fifth ETF in this lineup focuses on a part of the market people often overlook, but it's one of the biggest sources of dividends in the world. The companies inside this ETF are essential to daily life: utilities, telecom companies, energy providers, businesses that make the world run. These companies often have steady income no matter what the economy is doing, which is why they tend to offer attractive dividend yields. People still need electricity, phone service, water, fuel, and these companies keep paying dividends because their revenue doesn't drop dramatically during economic downturns. This ETF is loved by investors who want dependable, almost boring income. Sometimes boring is good, especially when you're getting paid. The sixth ETF takes things in a new direction. Instead of focusing solely on U.S. companies, it looks around the world, picking international dividend-paying giants. Why does this matter? Because different countries grow at different rates, and sometimes international companies offer higher yields than U.S. companies. This ETF spreads your income sources across multiple economies, which can lower risk and boost opportunity. Imagine earning dividends from companies in Europe, Asia, and beyond, all from one investment. It's a surprisingly smart way to diversify without thinking too hard about it. But here's a question you should really think about. Do you trust international companies enough to let them be part of your passive income strategy? Or do you feel more comfortable staying in your home market? Let me know in the comments. There's no right or wrong answer, just different perspectives. And that brings us to the seventh ETF. But before I reveal it, this is where things take a turn. Because this last ETF doesn't just pay income, it changes how you think about income entirely. It works differently from all the others, and a lot of investors don't even know it exists. And once you understand what makes it unique, you'll see why many people add it to their portfolios specifically to boost passive income without taking on the kind of risk they fear. This final ETF is the one that ties the whole list together, and its strategy might surprise you because it focuses on real assets instead of just companies. That's right. This ETF invests in things like real estate, infrastructure, and other income-generating physical assets. Why does that matter? Because these kinds of assets often pay steady income no matter what the stock market is doing. Rent still comes in, tolls are still collected, and utility fees keep flowing. This ETF essentially lets you tap into the cash flow of the real world. Many investors use it to add stability and income potential that isn't tied solely to corporate profits. Think about it. While other ETFs might rise and fall with market sentiment, this one produces money from tangible assets that people and businesses rely on every day. It's a clever way to boost income without gambling on volatility. Now, by this point, you might be wondering, okay, but how much are we talking about? How does this compare to a typical savings account? Well, here's the exciting truth. The average savings account today gives you less than 1% interest. Some high-yield savings accounts may get close to 4%, but let's be honest. Most people aren't earning more than a few dollars per month on a decent balance. In contrast, these dividend ETFs can pay anywhere from 3% to 7% in dividends, sometimes even higher depending on the market. That's several times what your money would earn sitting idle in a bank account. And remember, unlike interest from a bank, dividends can grow over time as companies increase payouts, giving your passive income a real chance to compound. Here's something I want you to consider. If you could earn more from your investments than your savings account pays, wouldn't it make sense to at least explore it? The key is not rushing in blindly. Diversification is critical, and that's exactly why ETFs are so powerful. You're buying a basket of assets, not relying on one company or one sector. It's safer, simpler, and in many cases, more lucrative than letting your money sit idle. Which makes me curious. How do you currently handle your savings? Are you sticking with a traditional account out of habit, or are you open to exploring higher-yielding alternatives? Drop your reply in the comments. I want to hear your approach. And here's a pro tip. Even though dividend ETFs can pay more than a savings account, it's important to reinvest. If you take dividends as cash, that's great. You're earning income. But if you reinvest them, you're essentially buying more shares that can earn even more dividends. Over time, this creates a snowball effect where your income grows without you having to add extra money. The magic of compounding isn't just a cliche. It's a real wealth-building strategy, and dividend ETFs make it simple to harness. Now, before we wrap up, let's reflect for a moment. 7 different ETFs, each with a unique approach. Some focus on stability, some on high income, some on quality companies, some on international markets, and one even taps into real-world assets. The beauty of this is you don't have to pick just one. A smart investor might combine several of these ETFs to create a diversified income portfolio. That way, you balance growth, yield, and stability, reducing risk while maximizing the potential to earn more than your savings account. Imagine the freedom that comes with multiple streams of income quietly growing in the background. If you've been paying attention, you now have a clear roadmap of options that could potentially change how your money works for you. But here's the catch. Knowledge alone isn't enough. You have to take action. Even small steps toward investing in dividend ETFs today can lead to meaningful income down the road. So here's my challenge to you. Choose one ETF from this list that resonates with your goals and learn a little more about it. Even researching just 10 minutes a day can give you an edge most people never take. And while you're at it, if you found this breakdown helpful, don't forget to like, subscribe, and share this video with someone who could benefit from smarter income strategies. It only takes a second, and it supports more content like this coming your way. Before we finish, let's do a quick thought experiment. If your savings account is giving you a few dollars a month, and one of these ETFs could give you 3, 4, or even 5 times that amount, how would that change your financial plan? Would you start investing sooner, or would you continue letting your money sit? I want you to be honest. Write your answer in the comments. I read every single reply, and I find it fascinating to see how different people think about income, risk, and growth. And one last insight. Dividend ETFs aren't just about income. They're about control. By choosing where your money goes, you decide the pace of your financial future. The bank doesn't dictate how much your savings grow. You do. With ETFs, you get transparency, liquidity, and the chance to benefit from some of the world's most reliable companies and assets. In essence, you're turning your money from a passive holder into an active earner without needing to spend hours managing individual stocks. So, to recap quickly, we explored 7 dividend ETFs, each paying more than your average savings account. We talked about stability, high yield, international diversification, options strategies, and real-world asset income. We asked thought-provoking questions along the way. Are you comfortable with international exposure? Do you prefer high yield over stability? How much control do you want over your financial future? These questions aren't just for thinking, they're for action. Your answers shape how you approach money, investing, and the life you want to build. And remember, dividends are only one piece of the puzzle. Combining them with a well-thought-out savings and investment strategy can dramatically improve your financial situation. Even small, consistent contributions to dividend ETFs can create meaningful income over time. It doesn't require luck, just consistency, patience, and knowledge, all of which you now have a starting point for. So here's my final ask. If this video helped you see a new path to earning more from your money, take a moment to like, subscribe, and share. And most importantly, I want you to engage. Comment below with which ETF strategy excites you the most, or which one you could see yourself starting with. The conversation in the comments helps everyone learn, including me, and might just inspire someone else to take that first step towards smarter income. Because at the end of the day, it's not just about the numbers. It's about financial freedom, control, and peace of mind. Dividend ETFs give you an avenue to earn passively, grow steadily, and build a future where your money works as hard as you do, maybe even harder. Start small, stay consistent, and watch what can happen over time. The opportunities are waiting. All you have to do is make the decision to start.